Hello and welcome back to my channel. It's great to see you here, and today I'm going to be talking about the 60/40 portfolio, and specifically if it's nearing its end, but also why you should care if it is. Let's dig in. So the 60/40 portfolio is a really traditional investment portfolio makeup. It's essentially created via using 60% equities or stocks and 40% bonds. It was part of the initial portfolio creation, modern portfolio theory, which I'll come on to talk about, but it's used really commonly in loads of different portfolios, from pensions to general investment accounts to just basic structures of investing. The reason being is that having 60% equities and 40% bonds is seen as a relatively balanced way to approach risk. It's also seen as a relatively good way to obtain diversification, so having a mixture of different assets. But crucially, what it also does is that it gives some level of anti-correlation. Now, don't worry, there's a more technical word for that, but essentially what it relates to is the fact that generally when stocks go up, bonds come down. And so when bonds go up, stocks come down. And this can be great to have in a portfolio because it means that the two are consistently balancing each other out. And therefore, when one's going up, the other's going down, and so on and so on. Traditionally, equities and stocks are seen as slightly higher risk and generally therefore grow more, whilst bonds are seen as slightly lower risk and therefore don't usually obtain the same levels of growth. Having both in a 60/40 portfolio means that generally the overweight part, being the equities at the 60, still drives growth within the portfolio, whilst the bonds often take care of the more income side of things and the more stabilization side of things. So it's still seen as a portfolio that very much targets some level of growth without being too aggressive and too eggs in one basket of just stocks. So it's an absolute favourite of loads of fund managers, and it's pretty common that you see this pop up in the likes of recommended or managed portfolios, and also in pensions, for example, where often pension managers will lean on the 60/40 for the majority of somebody's working life, and then they'll start to shift the balance as people near retirement. So it might go up to the other way, 60% bonds and 40% equities, and then even potentially up to 80% bonds and 20% equities, just depending on the individual, how much wealth they've got, and also their overall risk profile. But it's certainly one that is quite commonly used. And if you don't think you have it already, then it's always worth a check because it might be lingering there without you even knowing. The reason for this is due to modern portfolio theory. This was a theory developed in the 1950s by a chap called Henry Markovich. And essentially what he sought to do was get and have some level of growth from the markets whilst taking calculated risks, because there's always risks when you are investing. It's just about trying to balance them out. A lot of modern portfolio theory hinged on having uncorrelated assets. There's that technical word for you. And that is what I was referring to earlier, whereby bonds and stocks often move in different directions. The 60/40 portfolio has hinged mostly on equities and bonds, which are two sets of uncorrelated assets. But there can be others too, and I'll come on to talk about these as one of the alternatives that maybe need to be considered more nowadays. Because the 60/40 portfolio isn't quite what it used to be. In fact, it's been really struggling since around 2022, when we saw a bit of a pivot. Crucially, that pivot was that both the stock market and the bond market fell. Now, if you just rewind your minds back to 2022, what happened is that we saw increased conflict, notably with the invasion of Ukraine, and we therefore saw really high levels of inflation spiral across a lot of the globe. That includes the US, the UK, Europe, and many other nations as well, from Japan, China, and Australia too. These heightened levels of inflation were caused by all sorts of things, but one of them being that oil prices increased greatly. But there was also instability and uncertainty caused by these changes in macroeconomic policy and heightened global tensions. And all of this uncertainty led to both a fall in the stock and bond market. Now, I've very much simplified it. There's loads of other reasons why that also happened, but they were some of the key reasons why it specifically happened in 2022. Since then, we've seen inflation start to come down in most of the developed world, and that has been mostly due to heightened interest rates. Now, interest rates and bonds also have quite a close relationship. And as we've seen interest rates climb, as is usual, we've seen bonds remain relatively low. Often that's the case because if interest rates are high, cash as a relatively low risk option is more appealing than what we see from bonds. This is particularly pertinent when we're talking about longer term bonds. So there's all sorts of different time horizons that bonds can operate on. There can be the super short term, which are generally seen as the lowest risk, all the way through to long term, up to the likes of 50 years, which are generally seen as slightly higher risk. The reason being is that the future is pretty much unknown. None of us have a crystal ball. But if we've got a bond that lasts for 20 days, we can probably predict that most governments aren't going to go bust in the next 20 days. And as a result, they're a relatively safe bet. 50 years, who knows what the next 50 years has got to bring? And whilst we still hope that governments don't go bust in that time, or at least clues might be in place, we don't know. And so those longer term bonds are generally seen as higher risk. Now, those longer term bonds are struggling even more to compete with the likes of interest rates being higher and other assets too, hence why bonds have really struggled. So back in 2022, the 60-40 portfolio had a pretty nasty time. In fact, it really considerably fell. Now, depending on which makeup of it you're looking at, depending on where you're getting your stats from, will of course depend on what that exact percentage is. But the vast majority of the 60-40 compositions out there, fast forward to 2024-25, most of them have recovered, at least cumulatively over that period. And if you still look at a period of over a decade, so from 2015 to 2025, for example, even with a dip in 2022, they are now starting to climb back up. But it hasn't stopped those naysayers and questioners from actually saying, is there a bit of a shift here, and is the 60 portfolio actually dead? Is it dead, or does it just need rethinking? Because bonds aren't the only option. And if we've been taught anything over the last few years, it's that those alternatives can really come into their own. Other alternatives that could fit in the place of bonds are the likes of commodities, gold, and other precious metals as well. Let's hone in on that gold option. Gold has continued to hit all-time highs as we've seen wild swings in various different geopolitical spheres and increased tensions. Gold offers some sort of safe haven, i.e. people know what it looks like, it's been around for literally millennia, and therefore people like it as an investment. What this means is that they're generally keen to get involved, and so if it's used as an alternative or a balancer, it can often behave in a way that is favourable to a portfolio. There are other alternatives that can be considered too, things like real estate, perhaps private equity, or indeed new angel investment startup firms and the likes of unlisted companies. Now, depending on where you're at in the risk scale will depend on how appropriate some of these are. And real estate is a huge area, a huge asset class, and it can range from residential to corporate to commercial. There's so many different types, and all of them have different properties and therefore different performance metrics as well. But including them can offer further diversification just by having different assets, but could also present some of those potential changes in correlation as well. Some people will look to go what is called both long and short. Now, in the UK and across most of Europe, most retail investors, that's the likes of you and I, so not big corporations or professionals, don't have access to all of the tools that, for example, retail investors in the US often have with both long and shorts. These are more technical instruments that basically allow some level of balancing because it's hedging on the value of what's there. It'd take me a whole other video to fully explain what it means, and I will do that if people are interested. But as I say, given that most of us here in the UK and Europe can't access these, it's not super applicable. But it's worth knowing in case you read about it. Some will use now what is known as long and short strategies to try and replace what that 60-40 portfolio was previously doing. So why is all this relevant for you? Why would it matter if the 60-40 portfolio isn't working or is indeed dead, as some dramatic commentators are suggesting? Well, what it really goes to show is that we're in unusual times. This first modern portfolio theory was developed in the 50s, and it's worked pretty well since then. 2022 was kind of the turning point for that, and we've seen real change, and we've seen actually lots of portfolios not behave in a way that was expected, the 60-40 being absolutely no exemption. So take that as your kind of sign that actually, weirdly, we're in a funny time. Investments aren't performing as expected, and all of that stuff that you're seeing about inflation, interest rates, heightened political tensions, it is odd. It is difficult to predict, and it is doing things that economists, analysts, and market movers are not expecting. And what all this means is that actually just relying on some of those theories that have been previously created may not serve us always in a more modern world. I've not even thrown in the likes of crypto as a potential diversifier or balancer, as well as many other assets that are out there that have perhaps become more popular and more accessible since the 50s as well, when this portfolio was first developed. So what is your portfolio really invested? Take a look in on the likes of your pension. Have a look at whatever portfolio you've currently got, whether it's been created by you or whether it's been created by somebody else, a firm. Maybe it's time to be questioning some of those underlying theories and elements that are within a portfolio to make sure that you're still adapted for a modern world, an ever-changing world, and one that is still suitable for you and your risk profile. We never know what's round the corner, and that goes to show with investments. Lots of people advocate for put it in there and ignore it, which I'm very much for, unless we're thinking about some of these changes that can come in place. It's super important that you do stay on top of your investments no matter where they are, and ensure that they are adapting for a modern world. I don't necessarily think that 60-40 portfolio is quite dead. I think it just might need some tweaking and some further watching as well as we move through the next few years to see how that balance, how that correlation between the two assets continues to perform, and also how the various changes within inflation and interest rates pans out. As I say, none of us have a crystal ball, so none of us quite know what is round the corner. Thank you for watching this video. I hope you're enjoying my content. Do make sure that you like, subscribe, and comment if you are. And if there's anything that you want to see in future videos, do just let me know. Have a great day.